Okay, so you've had a few minutes to try this example. Let's take a look at it. So we're asked, the LMNO Corporation produces and sells batteries. For all salespeople, the mean daily sales is 84 units with a standard deviation of 16 units. So what that means is if we're looking at a bell curve like this one over here, the percents that I put in the bell curve are always the same. Those are constants. Those come right out of your book. It shows it in there. Those percents are always the same. What we fill in down below here come from the mean and the standard deviation of the data set. The center is always the mean. That's the 84. Then as we go each step in either direction, we go up or down by the standard deviation. Going to the left, we go down. So this step here, 84 minus 16 would be 68. 68 minus another 16 would be 52. 52 minus another 16 would be 36. So that right there is 36. Going the other way, 84 plus 16 is 100, plus another 16 is 116, and plus another 16 is 132. Again, the 16 is because the standard deviation is 16. Now we can look at our questions here. What percent of salespeople would you expect to sell more than 100 units? Well, here's 100 units. More than would be over here. I would have to add up those percents. 13.59 plus 2.15 plus 0.13 is 15.87%. The next question, what percent would you expect to sell between 52 and 116 units? Here's 52. Here's 116. We need to add up those percents. So I'd add up the 15.59, the 34.13, and 13.59. If I add those all up, we get 95.44%. So I would expect 95.44% of all salespeople to sell between 15 and 116 units on any given day. Now the next one here is kind of an incomplete question, but it gets us started. Pete sells 64 units. Find his Z-score. Find the Z-score for his sales. Remember, the Z-score for a number is that number, so 64 units, minus the mean. The mean here is 84. I would take that difference divided by the standard deviation, which is 16. So 64 minus 84 is a negative 20. And we divide that by the 16, which is a negative 1.25. So that's all I really asked for there was the Z-score. But I'm going to take it one step further now and ask, what does that mean? What does a Z-score of negative 1.25 mean? First of all, what does the negative portion mean? The positive or negative tells us whether we are more or less than the mean. Negative means we are less than the mean. 64 is smaller than 84. So yes, his sales is below the mean, below average. The 1.25 is how many standard deviations. So what this is saying is Pete's sales for that week are 1.25 standard deviations less than the mean. So that means it would be somewhere in here if we're looking at the bell curve. One standard deviation is the 68, another quarter of a standard deviation, somewhere in here. We can't get an exact percentage for that off of that empirical rule, but we get an idea. The Z-score, by the way, is more often used to compare two different numbers from two different companies. For example, let's do this. Let's say that Sam sells batteries for all salespeople. The mean sales is 124 units per day with a standard deviation of 18 units per day. Kim sells cables for all salespeople. The mean sales for cables is 97 units per day with a standard deviation of 14 units per day. Well, Sam and Kim have a little competition. In a week or in a day, let's say, Sam has a day's sales of 142 units. So let's make that a little more interesting. We got 148 units. Kim has a day's sales of 115 units. Who had a better day? Well, again, because they come from different populations, we can't just compare the raw numbers. 148 is definitely bigger than 115. But battery sales and cable sales are a little inherently different. So what we do is we compare them back to their own population using those Z-scores. The Z-score for Sam's sales is going to be Sam's sales of 148 minus the mean of 124 over 18. 148 minus 124 is 24. Divided by 18 is 1.5. Now that's positive, which means Sam is better than average, better than the mean. 1.5 standard deviations better than the mean, to be exact. Now for Kim, the Z-score, it's going to be Kim's sales of 115 minus the mean of 97 divided by the standard deviation of 14. Well, 115 minus 97 is 18. Divided by 14 is 1.2857143 approximately. We'll call that 1.29. So Kim's sales is also above average, but only 1.29 standard deviations above average. Sam's is 1.5 standard deviations above average. So I would declare Sam the winner. Any other questions off the statistics, the homework, or anything we talked about last week that you want me to go over? What do you have? Below 2 standard deviations above the mean. Okay, what I'm thinking is that's between the mean and 2 standard deviations above the mean. So what that is saying is we go back up to this curve. So it's from the mean, just 2 standard deviations above. So we're just adding those two numbers. So that is 47.72 if you add those two together. Yep, those percents are always the same. Yep. So all that would change is these numbers here, but this is always going to be the 2 standard deviations above the mean. Any other questions? Okay. Well, that is it for the business statistics portion of the course. The second half of Unit 2 is on merchandising and invoicing. There are 2 steps in delivering products to customers. At the end of those steps, we have the customer. In the middle, we have usually a retailer of some sort. And then before the retailer, we have a supplier. That supplier could be a manufacturer or maybe just a wholesaler. For tonight's purposes, we're going to assume a manufacturer. If it is the manufacturer, they're going to serve as their own wholesaler. So it's all one entity coming from that supplier. So what we're going to be looking at tonight is this chain from the supplier, which is the manufacturer and wholesaler, to the retailer. Now, sometimes those manufacturers and wholesalers will sell direct to a customer. Because of that possible direct link, there has to be some incentive for retailers to purchase that product. Well, why would a supplier want to sell it cheaper to a retailer than it could sell it directly to the consumer? Well, a couple of reasons. One is the supplier is not necessarily, their best skill maybe isn't necessarily dealing with customers. Second, selling to customers, they're going to sell one or two at a time, whereas selling to retailers, they're going to sell a large bundle at a time, whatever they're going to order to fill their stocks. So they're willing to sell it a little bit cheaper to a retailer because they're going to sell a larger volume. So they still come out further ahead in the end. So what that is called when a supplier sells cheaper to a retailer than to a customer is a trade discount. And that trade discount comes off of whatever the list price is. Now, the list price is what that supplier would sell directly to the consumer. So let's say that a retailer has established themselves, they're ordering enough product, and usually that's one of the first things that a trade discount goes off of is, have you ordered enough product? How much product have you ordered? So let's say they've ordered enough product to earn an 8% trade discount. How much would they pay for items listed at means list price, $840? Well, there's a couple of different ways we can look at this. We can find our 8%. 8%, of course, is 8 out of 100. Remembering that the 8 represents the discount. The 100 is the full amount, which in this case is the list price. So that means as I set up my proportion, $840 is my list price. That goes on bottom. I cross multiply and divide to get my missing number. 8 times 840 is 670 or 6,720. Divided by 100 is 67.2 or $67.20. That is the amount of the trade discount. However, we don't want the trade discount. We want how much they would pay. The amount they pay is referred to as the net price. So we would take the list price, which is that $840, and we would subtract the trade discount, which is $67.20, and that will give us that net price. Which, as we subtract, we're going to get $772.80, I believe, is our net price. Now, as you're looking at this, some of you may have recognized this to be similar to a tool we used in Unit 1 when talking about percent increase or decrease. A trade discount is just a percent decrease. So we have the dollar amounts we filled in here, the 840, the 6720, and the 772.80. Let's look at the percents. That list price is 100%. That's what we started out with. We subtracted a trade discount of 8%. The net price has to be 92%. Now, as we're looking at this, the 8% is the discount rate. The 92% is the net price equivalency rate. So rather than going through, if I didn't want the amount of the discount, if I just wanted the amount of the net price, rather than going through the trouble of finding the discount and subtracting it, I could actually just use the net price equivalency rate. I know that the net price is 92% of the list price. And since this is a calculation where we have that whole amount and we're trying to find that piece, we can go ahead and just use a rate. Our list price was the $840. We could just go ahead and multiply that by the rate for 92%, which is 0.92, will give us $772.80. So the formula is our list price times our net price rate equals the net price. So let's look at an example where we apply that formula. Let's say Stevie's Auto receives a 12% trade discount. Find the net price for items listed at $250. Well, pretty straightforward. List price is $250. What's our net price rate here? Well, off of 12%, it's going to be 100 minus 12, which is 88%. So what's going to go in there is 0.88. 250 times 0.88 is $220. That is our net price. Now we can do a similar problem to that. Let's say Frankie's Specialties receives a 15% trade discount. Find the list price for items with net price of $5,270. So now this one, we're given the net price. That's the last amount. What is our net price rate? Well, we have a 15% discount. 100 minus 15% is 85. So that's 0.85 that goes in there. And it's going to be the list price that we're looking for now. To solve for the list price, we're just solving an equation. We're going to divide by 0.85. So we divide by the 0.85, so we've got 5270 divided by 0.85. The list price is $6,200. Now you should always stop and make sure these answers make sense. The list price should always be larger than the net price. So $6,200 does make sense for the list price. It's bigger than the net price. Well, quite often, we have things arise where there's more than one trade discount that comes into play. For example, let's say that a lot of times what will happen is you have your sales might earn you a discount. Let's say you earn a 12% trade discount based on your sales volume from last period. Let's say there's another promotion going on, and for that promotion, you received an additional 7% trade discount. And there might be another special project or whatever going on. Maybe you allow the company to post advertising in your business, or they have a new product that they want to get out there, and you've agreed to put that product on the shelf and test market it for them, or whatever. And you get an additional 4% trade discount for doing that. Well, that adds up to 23%. Does that mean you get a 23% trade discount? No, it doesn't. Trade discounts when there's multiple ones like that, are treated as what's called chain discounts. They don't all happen at the same time. They happen sequentially, one after the other. So you apply the 12% first, then the 7%, and then the 4%. For example, let's say that there's items here with a list price, let's make this simple on ourselves, of $1,000. The way this would work is you apply the 12% discount first. So it's 1,000 times what? Not 0.12, but 0.88. That's the net price rate, remember. That's $880 is what the net price would be after that first trade discount. Now then we apply the 7%. So we take that $880 times what? What's 100 minus 7? 0.93, very good, 93%. So 880 times 0.93 is $818.40. And then we're going to take that $818.40 and apply this final 4% discount, which means the net rate would be what? .96. 100 minus 4 is 96. So times 0.96. 785.66. So $785.66 is the final net price after all of those discounts. Had we just taken a 23% discount, by the way, that net price would have been $770. So obviously you get less of a discount by stacking them sequentially rather than putting them all at the same time. Well, we see what happened here is we just took each of these net price rates and we multiplied by them one after another. So if I take that discount, that trade chain discount, and the way it's often listed looks like this. 12/7/4 is the notation for that chain trade discount. I could go ahead and just take, well, 100 minus 12 is 88, so 0.88, times 100 minus 7 is 93, so 0.93, times 100 minus 4 is 96, so 0.96. Those are just the percents I multiplied by here at each step. I'm just putting them all together. And if I multiply those all together, I get 0.785664. That number there is called the net decimal equivalent. It is basically the single discount equivalent, or the single net price equivalency rate, combining all of those trade discounts into one. What is that net decimal equivalent used for? Well, I could take my list price times that net decimal equivalent, and it'll give me my net price. So here, if I had the $1,000 list price times 0.785664, notice I did not round that. I get $785.66. I'll round it to 66 cents. So $785.66, which is, by the way, what we found up here. Just a lot simpler to do it all at once. Now, if that is the net decimal equivalent, what if we want to find the amount of the trade discount? Well, now that I have that net price, I could just take the list price minus the net price and get the amount of the trade discount. But there is another rate that we use called the single discount equivalent. And it is found from this net decimal equivalent. We find it by taking 1 minus the net decimal equivalent. Well, why does that work? Well, the list price is 100%. That's the 100%. Minus the net decimal equivalent, well, that is the discount. Bless you. Oops, that's not the discount, that's the net price. So if we take the 100%, subtracting the net price, what's left is the discount. So we have 1 minus 0.785664 gives us 0.214336. That is the single discount equivalent. What would we use that for? Well, if we take the list price times the single discount equivalent, we get the amount of the trade discount. So if we took the $1,000 list price times 0.214336, that gives us $214.34 rounded to the nearest penny. You'll note those two should add up to our list price of $1,000. So let's do an example where we do this all together, all at once. So let's say that Taylor receives a 7-11-3 trade discount. How much does Taylor save on items listed at $2,800? So we want to know how much Taylor saves. Are we looking for the net price or are we looking for the amount of the trade discount? The amount saved would be the amount of the trade discount. So to find the trade discount, we want the single discount equivalent. To find the single discount equivalent, we're going to take our trade discount, 7-11-3, (100 minus 7 is 93. So that's 0.93. What happens to the 11? Or what does it become? But 100 minus 11 is 89. So as a decimal, that's 0.89. What do we put in for the 3? 0.97. Very good. 100 minus 3 is 97. So as a decimal, that's 0.97. So we multiply those together. 0.93 times 0.89 times 0.97 gives us 0.802869. That is the net decimal equivalent, NDE. Remember, the net decimal equivalent is used to find the net price. We're not looking for the net price, we're looking for the amount of the trade discount. So we need the single discount equivalent. The single discount equivalent is found by taking 1 minus the net decimal equivalent. So we do 1 minus 0.802869 equals 0.197131. That is the single discount equivalent. So to find the amount of our trade discount, we take our list price of $2,800, that's our list price, times that single discount equivalent. Giving us 551.97. And again, because we use the discount equivalent, that is the amount of the trade discount. Any questions? Well, it's time for you guys to try one. Phil's receives a trade discount of 8.9. So there's only 2 of them stacked there instead of 3 of them. For items listed at $740, find one, the trade discount, and 2, the net price. I'll give you guys a couple minutes. Okay, so let's take a look here. We have the 8.9 trade discount. So we're going to start with that. What do we do with the 8? Subtract from 100. You got it? Which is going to give us 92. So it becomes 0.92. Good. Times 0.91. Good. We do 100 minus 9 is 91. That becomes 0.91. We multiply those together, and we get 0.8372. That amount Does that relate to the discount or the net price? That relates to the net price. The amount for the discount would be 1 minus that. 1 minus 0.8372, which is 0.1628. That relates to the discount. So to find the amounts, I take my list price of $7.40 times 0.8372, which gives me $619.53. That, again, that amount was related to the net price, so that is the net price. To find the discount, we take the list price, $7.40 times the discount rate, 0.1628, which is going to give us $120.47. That is the amount of the trade discount. How many of you came up with those? Okay, anybody have any questions? You know what you did? Okay, you had the right numbers just for the wrong piece? Okay. Okay. So now, what this is, that net price, is what goes on an invoice. There are going to be several critical things that go on an invoice. One is going to be an invoice date. There's going to be an invoice amount. And then there's going to be terms of sale. The invoice amount is that net price that we get after applying any trade discount. The invoice date is going to start some timelines that we're going to discuss in the next hour. The terms of sale are the important piece. The terms of sale define a couple of things. If there is a further discount beyond the trade discount for prompt payment, this is called a cash discount. It's kind of a misnomer because cash discount used to mean you got a discount if you paid right away that day. Well, in modern society, that doesn't happen really anymore. So a cash discount has been changed into you get a discount if you pay earlier than you need to, and it'll define that parameters as part of the terms of sale. It'll also define how long before the total is due. Even if you don't pay early to get that cash discount, you still only have a certain amount of time to pay. That's defined as a credit period. And other things that might be defined in there is shipping. A final thing is special dating. We'll talk about that as well in the next hour. It is time for our break, so let's go ahead and take our break at 6:21. We'll come back at 6:31 and we'll talk more about these pieces of an invoice. Time to roll on. So the only part we've really specified so far on here is that the invoice amount is that net price coming out of the cash discount. The invoice date is fairly self-explanatory. That is the date that the invoice is generated. And that date that the invoice is generated typically coincides with shipping. Generally not the date the order is received, it's the date that the order gets sent out from that supplier towards the retailer who's purchasing it. So let's look at that part of the terms of sale. Now we said the invoice date starts a timeline. That timeline is specified by the terms of sale. So at the beginning of that timeline, we have the invoice date. At the end of that timeline, we have payment due. But generally, within that timeline, the terms of sale define two different periods. One is something called the discount period. That is the period of time where that buyer can receive a discount for paying early. And of course, there is a date. It is the end of the discount period. Well, starting from that invoice date and going all the way to the date that payment is due is the credit period. So technically, the credit period includes the discount period, but it usually extends beyond the discount period, and it goes up until that final date that the invoice is due. It must be paid. The invoice due date marks the end of the credit period. Generally, an invoice or a sales contract will state if payment is not received by that date, by the end of the credit period, interest of a certain percent will be charged. Technically, what happens is on that date, that end of that credit period, this invoice will automatically convert into what's called a note. A note is really just a form of a loan where interest is charged. In Unit 3, we'll talk more about notes and that charging of interest. For now, we're just going to assume bills are paid by the end of that credit period. So how do those terms of sale define this timeline? Well, there's a notation that pops up very similar to our trade discount that might look like this. Notice we use those slashes again. This first thing here defines the discount period. And what that is saying is the 2 is saying 2% discount. The 10 is saying if paid in the first 10 days. 10 days after what? Well, that invoice date. The second one defines the credit period. The N stands for net amount. The 30 means due in 30 days. Again, 30 days from the invoice date. So both the discount period and the credit period start at the invoice date. So let's say we have an invoice that is dated March 18th, 2018. Looking in the future a little bit. And our terms. 1/5, not 30. What this is saying is we have a timeline. What is the beginning of our timeline here? What date? The invoice date, March 18th. How long is the discount period? Five days. So 5 days from March 18th is March 23rd. During that period of time, they get a discount of what percent? For this one, it is 1%. What is the end of the credit period over here? 30 days after March 18th, yes, the invoice date, which is going to be April 17th. So now, important question. What if we don't have a calendar where we can just count up the days? And what if we don't have it memorized which months have 30 and 31 days? In your textbook, I believe it's on page 396. There is a calendar that has all the days listed out from January 1st to December 31st, and they are numbered. And it is still 396 even in the new version of the textbook. So looking on this, I can find what day of the year any date is. So for this problem, I would look up March 18th first. That is my invoice date. March 18th, if I look on there, I find March on the top of the table. I trace it down to 18, and I find that March 18th is what day of the year? 77. Very good. If I add 5 to that, 77 plus 5 is 82. I can look on there and find day 82. That's still in the column for March, and I can trace it over to the left. That is March 23rd, just as we said. I go back to 77, and I add 30 for that credit period. What is 77 plus 30? 107, 107. So we look on here, we find 107. We see that is in the column for April, and we trace that over to the 17th. So April 17th is the end of the credit period. I would put a bookmark on that page 396. From now until the beginning of May, we're going to be using that page a lot. So let's say we have a date of July 24th is our invoice date. I'm not going to put a year on there. Our terms, 210, 115, net 60. Where does our timeline begin? Our invoice date of July 24th. If I look in my book on my calendar, July 24th is, what day is that? 205. Now, there are two discount periods listed here. We have a 2% discount period that goes 10 days. And then we have a 1% discount period that goes to 15 days. No, if you pay in the first 10 days, you do not get both a 2 and a 1% discount. What that means is you get a 2% discount in the first 10 days. It drops down to 1% between the 10 and the 15. And then, of course, the final end date here is at 60 days. That's where the net is due. So I'm going to start with my 205. That's the beginning of my timeline. If I add 10 days, what day of the year would that be? 215. Good. I go back to the 205. I always go back to that starting date. If I add 15, I would be at day 220. Very good. Now for the end of my credit period, I should go back to 205 again, and I add 60 to get 265. Now I can go to my table and look up those dates. 215 should be July. Oops, not July, but August what? August 3rd. 220 is going to be August 8th. And 265 is September 22nd. Very good. So if they get one of the discounts, let's say they earn or they pay early enough to get the 2% discount. We take that invoice amount times the term that really we use here is called a complement of the discount to give us the amount paid. What do we mean by that complement? Well, 2% would give us the discount if we found 2%. If there's a 2% discount, what amount is paid? What percent? 100 minus 2 would be 98%. So it's the invoice amount times 0.98 would give us the amount that would have to be paid. So now let's take a look at what happens when we include the actual invoice dollar amount and then a payment date into these problems. So let's say our invoice date is September 18th. The invoice amount, we'll go $1,240. Terms, $210 net 30. And we're going to ask how much is due. In other words, how much is paid if paid on September 27th. So let's set up our timeline. Of course, the beginning of our timeline is September 18th. We do have a 2% discount period that ends after 10 days. That's going to be September 20th or 28th, I should say. The end of our credit period is going to be October. If we need to look up the dates, we can. September 18th is 261. Plus 30 would be 291. 291 is going to be October 18th. Well, this invoice is paid September 27th. Is that within the discount period or not? Yes, it is. That's just within the discount period. So to find the amount paid, remember it is the invoice amount times that complement of the discount equals the amount paid. So for this problem, the invoice amount is $1,240 times what's our discount? Discount's 2%, so its complement is 100 minus 2 or 0.98, 98%. So $1,215.20. Any questions there? Okay, I'm going to have you guys try one. Our invoice date is December 19th. The invoice amount, $4,830. Our terms, 210, 115, net 30. How much is paid if paid on January 1st? I'm going to give you guys a minute or two to work on that. Okay, so we have a timeline here that starts on December 19th. The 2% discount goes 10 days. That's going to end on December 29th. The 1% discount goes 15 days, so it goes 5 days past that, or 15 days from December 29th. How do we deal with that? Well, if we look up December 19th on our table, we get that is day 353. If we add 15 to that, we get 368. That is beyond the end of the year. How many days are in a year? 365. We subtract 365, that is 3. So this would be on day 3, otherwise known as January 3rd. We don't even really need to know when the end date is here, but we could go ahead and do it. We would take our 353 plus 30 is 383. Subtract 365 would give us 18. So January 18th would be the end of our credit period. The payment was made on January 1st, however. Right in here is our payment. What discount do they get? 1%. So we're going to take that $4,830 and multiply by what? 0.99. Where'd the 99 come from? The complement. 100% minus 1% is 99%. Which is going to give us 4781.70. Okay, well that part is fun enough. We need to talk about invoice date modifiers. There are several reasons for invoice date modifiers. The first one is slow shipping. This often occurs with larger products, larger payloads. It might take, if it has to be shipped by semi across the whole country, it may take 7 or 8 days or more to get from the supplier to the retailer. Well, it's not fair that if there's a 10-day discount period, that by the time the merchandise gets there, they only have a day or two to make their payment and still get the discount. So there is a modifier they use, ROG, which stands for receipt of goods. And the way that works is, let's say we have an invoice dated April 8th for an amount of $7,820 in terms of 210 net 30 ROG. That means that when we go to make our timeline, this is not going to start at April 8th. We need more information. The shipping company confirmed delivery on April 16th. What that means is the invoice date is effectively replaced by that delivery date. So what starts our timeline is April 16th, the delivery date. So that means our discount period of 2% extends 10 days from April 16th, which would be April 26th. And our discount period goes until May 16th, 30 days after April 16th. So if we have a date of June 5th, an invoice amount, $2,180. Terms of sale, 110, net 30. ROG. Delivery is confirmed on June 12th. How much is paid on June 20th? So if paid on June 20th, how much do they pay? What's the date that starts their timeline? June 12th. The ROG means the date the delivery is confirmed. So June 12th. Which means our discount period goes until June 22nd. Very good. 10 days past the 12th. And then, of course, July 12th would be 30 days past June 12th. Again, you can use that calendar in the book if you need to. They pay on June 20th, which means they get the discount. So how do we determine how much they paid? $2,180 times. They're only going to get a 1% discount, so it's going to be times 0.99, 100 minus 1. Giving us $2158.20. So $2,158.20 is what is paid. Our second invoice date modifier is EOM. EOM stands for end of month. Now, end of month is just a generic term that we use in this class. Technically, it could be end of period. A period could be a week, it could be 2 months, it could be whatever the business determines is a period that they're going to use for their bookkeeping. Where end of month usually gets used is for smaller companies that don't have a full-time bookkeeping department, or they might have just a single bookkeeper that has to keep track of expenses and expenditures and all the invoicing. I mean, larger corporations have a whole accounting staff, and that staff might have one person who does the expenses and one person who keeps accounts payable and one person who just does invoices, maybe even several people that just do invoices. So they process and send out invoices every day. Smaller companies might even be a sole proprietor who's doing their own bookkeeping. Many times don't have the kind of staff to process invoices every day. So what they do is they might send out invoices at the end of each week, or they might send out invoices at the end of each month. And usually what they do is they pick a slow day. Like a sole proprietor, if they're doing it weekly, maybe Mondays are their slow day. So every Monday, they do their invoices and send them out. Well, rather than have to deal with every different type of period, for this class, we are going to assume that the period is always a month. Now, the end of that month, again, doesn't have to mean the end of the calendar month. A business might choose the 15th of every month to be the day they do invoices because maybe the middle of the month is slower than the end of the month. A lot of times at the end of the month, you have to do your end of the month books, book adjustments and stuff like that. Well, again, to simplify things for this class, we are going to assume that the end of the month is the actual last day of the month. So we're going to assume that the actual end of the month is the end of the month. So let's say we have like June, July, August are our months. So rather than having a date that's picked by the company, to keep it simple, we're just going to assume that the last day of the month is the end of our period that we're going to use. So what's going to happen is all the invoices generated, every time product is shipped out, they generate an invoice, and it's going to go into a file. And at the end of every month, they pick up all the invoices from that file, and they process them and send out those invoices to customers. Now you'll notice I left a little gap right here. I didn't go all the way to the end of the month with it, did I? Well, because a lot of times your loading dock, you shipped out the product, you generated the invoice, but it gets thrown in a file and it might not get carried into the business office for a day or two. So there might be invoices sitting out there that don't make it into the June batch. That might be a 1-day delay. It might be a 2-day delay. It depends on the company and the process. And it might be different every month. There might be months where an invoice generated on that last day gets put into that batch. Well, again, we need to simplify things for this class. So what we're going to do is for this class, we're going to assume any invoice generated on or after the 26th does not make it into that batch. So that gets into the next month's batch. So that means that starting on the 26th of June, all of those invoices all the way up to the 25th of July are going to get in the July batch. They're going to be sent out on the last day of July. Then starting on the 26th of July, going through the 25th of August, all those invoices get put together. They get sent out on the last day of August. So what that means is, let's say that invoice date is July 18th. If the terms are EOM, that invoice does not get sent out to the last day of July, which is July 31st, which means the timeline starts then, the last day of that month. Did you guys lose me again? So let's say that our date is July 27th. Does that make it into the July 31st batch? No, that is on or after the 26th. That ends up going into the August batch. That gets sent out on August 31st. So that is the effective date of August 31st, is where that timeline is going to start. So let's look at some invoices here. So we have an invoice date of May 28th for an amount of $3,500. Terms, 210 EOM. Notice there is no net 30. EOM is always assumed to be a net 30. And actually, I'll talk about that a little bit here in just a second. Find the amount paid on July 8th. Now, July 8th seems like a long ways off. But where does this timeline start? Does this make it into the May batch? No, it is after the 26th. So that goes into the June batch. And the June batch is dated the last day of June, which is June 30th. rest of this is pretty simple. 210 means it's just the 10th of the next month is where that discount period ends. EOM, as we said, was assumed to be a net 30. It's interpreted a couple of different ways. Some would interpret it as saying it's due the 30th of the next month. Others say end of month means end of month, which means it's due the last day of the next month. So if you put down July 30th or July 31st, depending on which interpretation you're working under, either one could be true. Either one could be correct. We're going to go with 30 days. Now, some people point out that there is one big wrench in that. What if that next month is the month of February that doesn't have 30 days? Well, again, some would interpret that to say, well, it's due on the 28th of February, the last day. Or others would say it's 30 days, so it's due on March 2nd. Again, depending on your interpretation, either one is correct. For this course, we're just going to avoid February with EOM. And we're going to assume it is the 30th of the next month, always. So that July 8th date of payment gets the 2% discount. So how do we figure out how much is paid? What do we do to our $3,500? .98. Good. We get a 2% discount this time. 3,500 times 0.98 should be 3,430, and it is. $3,430 is the amount paid. So you can see this EOM dating can be tricky. You have to be very careful to make sure that that date is before the 26th, because if it's on or after the 26th, it goes into the next month's batch. So let's have you guys do an invoice date. November 2nd. For an amount of $3,100. Terms. 310 EOM. How much is paid if paid on December 12th? I'll give you a minute to do that. When does our timeline start? November 30th, our last day of November. Discount period ends December 10th. How much is paid on the 12th? The full amount, $3,100. They don't get a discount. Let's do another one. So our date is February 26th. An amount of $6,200. Terms. 310 EOM. How much if paid? March 27th. I'll give you a minute for that one. Some of you are seeing the problem here. When does this technically start? Does it make the February batch? No, it goes the March batch. So it goes in the end of March, which is March 31st. So the discount period would end April 10th, right? March 27th is actually paid before the invoice is sent out, which is not impossible. It does happen. So they do get the 3% discount because it is paid before the end of that discount period. So what are we going to do with that? We're going to take our 6,200 times what? 0.97. Good. 100 minus 3 is 97%, which is going to give us 6,014, I believe. But let's do this. It is $6,014 paid. Any questions? Okay, now here's a question to put out there. And people want to argue this one, but this is the way it is done in industry. Let's say we're closing in on an April 10th date and we don't have the $6,200, but we still want to take advantage of that cash discount. So we're going to pay as much as we can. Let's say we pay $3,000 on April 9th instead of paying the full amount. Do we still get credit for the cash discount? And a lot of people say, no, it's all or none. Well, in the real world, you get credit for what's called a partial payment. The way it is calculated is a little bit strange. A lot of people want to find 3% of this and just add it on. That's not how it works. Remember, this is the amount that is credited times that complement, in this case, 0.97 because it's a 3% discount. That equals the amount that is actually paid. So if there is a $3,000 payment, that goes in here for the amount paid. To find the amount that is credited to the account, what are we going to do? Well, we're going to solve this equation. We have to get rid of the 0.97 by dividing by 0.97. So the credit to that account will be 3,000 divided by 0.97. So $3,092.78. It is time for our second break. So we're going to take our second break and we're going to come back and talk more about these partial payments. It is 7:19. Let's come back at 7:29. Okay, it is 7:29. So let's go ahead and take a look at how these partial payments tie into everything. So we're going to look at an invoice that is dated May 23rd for an amount of $4,000. Terms 210 net 30 ROG. Delivery is confirmed on May 29th. If a partial payment of $2,500 is made on June 6th, find the balance due. The balance due, or sometimes called the outstanding balance, is the amount that has to be paid, or that is supposed to be paid at the end of the credit period. So let's start our timeline here. When does this timeline start? Yeah, ROG means we go to the delivery confirmation date of May 29th. 210 again, our 2% discount period ends on June what? June 8th? Perfect. Then, of course, the credit period is going to end on June 28th. Their partial payment of $2,500 falls June 6th. So they paid $2,500 on June 6th. They get credit for that 2% discount. So we need to find the amount of credit. So the credit amount is multiplied by what number? 0.98, because of the 2% discount. 100 minus 2 is 98%, so that is 0.98. And that equals the amount paid, which in this case is $2,500. We solve by dividing by 0.98. So we get the credit is, what is that, 25, 50, 51? No, 25, 51.02. The $2,551.02 is the credit. The balance due? Well, the invoice amount was $4,000. Back up here off the invoice. We subtract that credit, $2,551.02, to get $1,448.98 is the balance that is still due, that must be paid by that June 30th or June 28th deadline for the end of the credit period. Any questions on that? Okay, well, our next piece of information is freight charges. In other words, shipping costs. There are two terms that come into play with shipping costs. Both of them start with the phrase free on board. Free on board is specifying which one does not pay. So if it is FOB, free on board, destination, who's at the destination, the buyer or the seller? Well, it gets shipped to the buyer, right? So the destination is the buyer. It is free at the buyer. That means the seller pays the freight. FOB, shipping point. The shipping point is where it starts at. Well, that is where the seller is, which means it's free to the seller. So the buyer pays the freight costs. In about 99% of all transactions, the buyer is going to pay the freight costs. However, this actually further complicates things a little bit, because the days of a shipping company picking up a product, hauling it across the country and delivering it, and then waiting for that place that it's delivered to pay for the freight, those days are gone. The old COD and stuff like that, it just doesn't happen anymore. Mostly because shipping companies got stuck with a lot of issues because they got to the destination and people still didn't want to pay. So what usually happens now is even though the buyer is going to pay the freight, the seller prepays freight or shipping costs of, when we see that phrase, the seller prepays or seller prepaid freight or shipping costs of a certain amount, that is saying that the buyer still has to pay the freight, but the shipping company wouldn't pick it up until the freight had been paid. So the seller prepaid the freight, paid the shipping company. That means the buyer has to reimburse them. So generally the phrases we see that will not say free on board, it'll just say seller prepays freight of, or seller prepays shipping costs of. So let's take a peek at some examples. So let's say we have an invoice date of March 23rd. Invoice amount of $3,800. Terms 110 net 30. Buyer prepays freight of $600. How much is paid if paid on March 30th? Well, our timeline starts on what date? March 23rd, correct? There are no modifiers in our term, so it stays on March 23rd. When does our 10% discount, or sorry, our 1% discount end? $10 days from March 23rd puts us at April 2nd. So it's paid on March 30th, which means we are good as far as the discount. We've earned the discount. Now this $600 is not included in the invoice amount. So that's going to get added on to that. The total due here is $4,400. So do we do 4,400 times 0.99 because of the 1% discount? Say no. No, why not? This $600 is a real cost. It's not part of the invoice. It's a reimbursement. They never get a discount on freight. So to find the amount paid on March 30th, we take the invoice amount of $3,800 times what percent discount do we get? 1%, so times 0.99 gives us $3,762. And then we add the $600 to that, giving us a total of $4,362 that is paid on March 30th in order to pay off that invoice. Well, it gets to be more fun than that. So let's say our date is October 3rd for an amount of $7,400. Seller prepays $1,100 in freight. Terms, $210 EOM. Partial payment of $3,000 on November 8th. Find the balance due. Where does our timeline start for this one? It does start October 31st, right? October has 31 if I remember right. Yep. So it's the last day of October, which means the discount period, the 2% discount ends November 10th. Then credit period ends November 30th. They make a partial payment on the 8th. That's that $3,000 payment. Do they get a discount? They do. So do I figure out the credit? Do I take that 3,000 divided by 0.98? Obviously, I'm asking with a grin on my face, so the answer is probably no, right? What do we have to consider first? Freight. Freight, not only is there never a discount on freight, but freight is always paid first. So we start out by taking that $1,100 payment, oops, sorry, not $1,100 payment, the $3,000 payment, and we pay the freight, which means only $1,900 gets applied to the invoice. So the credit times is 2%, so it's 0.98, equals that actual payment of $1,900. So the 1,900 now is divided by the 0.98. The credit is $1,939. I'm just going to divide it up. $38.78. So $1,938.78 is the credit. So the outstanding balance, we take the $7,400, which is the amount of the invoice, and we subtract the $1,938.78, $5,461.22 is the balance due by the end of the credit period. What do you think? Loads of fun? It's pretty easy. The partial payments do get a little tricky, I admit to that. Let's have you guys try one. Our invoice date is November 25th for an amount of $4,900. Seller prepays $800 in shipping and freight. Terms 115 ROG. Oops, sorry, 115 net 30 ROG. Delivery confirmation on December 3rd. Find the balance due if a partial payment of $2,500 is made on December 12th. I'll give you guys a couple minutes. What date does our timeline start on? December 3rd. Very good. It's receipt of goods, so we go off the delivery confirmation date. So that means with a 115 discount period, that discount period ends on December 18th. The credit period ends on January 2nd. That's 30 days after December 3rd. Well, there's that payment. $2,500 is made December 12th. Well within the discount period. What do we do with that $2,500 to start off with? Subtract the freight of $800, which means that $1,700 goes towards the invoice. So now to find the credit amount, what discount did we get? 1%. So it's the credit amount times 0.99. Very good. Equals that 1,700. And we divide by 0.99. So the credit is equal to $1,717.17. Credit. So then what do we do? Subtract it from the $4,900 invoice. Giving us $3,182.83 is the balance due by January 2nd. What do you think? Not so bad? Cool. Well, let's do this to you. PDL Corp orders 5 sets of furniture listed at $4,000 each on April 28th. PDL receives a 411.7 trade discount. The seller prepaid $1,200 in freight. The terms are 310 EOM. PDL pays $8,000 on June 8th. Find one, the balance due, and two, the due date, the date that it's due. So let's walk through this a little bit. This contains pretty much everything we've done since 5:30 this evening. The first thing we must find is the list price. Now, the list price is right out there, but it's hidden a little bit in this problem. They don't just give you the dollar amount. I say 5 sets at $4,000 each gives us a total list price of $20,000. So that is the list price. Next, we need to figure out what goes on the invoice. Remember, what goes on the invoice is the net price. To figure out the net price, we use the trade discount, the 411.7. The 4 turns into what? 0.96, good. Times the 11 becomes 0.89, good. Times the 7 becomes 0.93. 0.96 times 0.89 times 0.93 gives us 0.794592. Now, if we're looking for the amount that goes to the invoice, is that the number we want, or do we want 1 minus that? 1 minus that would give us the discount. This is the net price amount. So this does give us the net price. So that is the number we want. So we're going to take our list price, 20,000, times 0.794592 to get 15,891.84. Is the amount that goes on the invoice. So now let's do our invoice timeline. What date is the timeline start on? Well, April 28th, but we have a modifier of EOM. So it doesn't get into April, it has to go into May. Very good. The last day of May is May 31st. It is a 310 EOM, which means that discount is going to end on June 10th, and it is 3%. EOM, of course, means it ends on the 30th of the next month, so June 30th. So now we have the partial payment of how much and when? $8,000 on June 8th. So on our timeline here, this is June 8th, $8,000. What do we have to do to that first? Subtract the freight, prepaid freight of $1,200. So 6,800 is what gets applied to the invoice. So now, to find the credit amount, it's going to be times what number? 0.97, because it's a 3% discount. 100 minus 3 is 97. And that equals that amount of 6,800 that we paid. So now we divide by 0.97 to get the amount of the credit is $7,010.31. That's the credit. Well, what was the original invoice amount? $15,891.84. So we subtract the credit of $7,010.31. To get a balance due of $8,881.53 due on June or by June 30th. What do you think? Unfortunately, no. Sorry. Let's have you guys try one, and then we'll call it a night. FML Corporation purchases items listed for $16,000 on December 27th. FML receives a 726 trade discount seller prepaid $1,500 in freight. The terms are 210 net 30 ROG delivery confirmed January 4th. FML makes a $7,000 partial payment on January 12th. Find balance due and the due date. I'll give you a few minutes. So our list price starts out at $16,000. I made it a little bit easier for you, and I gave you the full price right there. I'm going to take a little bit of a shortcut here. I'm going to multiply that list price by, from my trade discount of 7, I get 0.93. From the 2, I get 0.98. From the 6, I get 0.94. So I'm just going to multiply that right out. Gives me the net price of $13,707.46. Now let's stop right there. How many of you got that much as the net price? Any questions on how we got to the net price? Okay. So that's what goes on the invoice. That's the invoiced amount. Next, let's look at our timeline. Timeline starts on what date? January 4th. Discount of what percent? 2%. Ends on January 14th. The credit period ends on February 3rd. Very good. So the outstanding balance is going to be due on February 3rd. We found that part already. Next, we make our payment, our partial payment of $7,000. So we got that partial payment of $7,000 made on January 12th. That part's good. We're going to get the discount, but first we have to subtract the freight of $1,500 to get $5,500, which is going to go towards the invoice. Then what? Perfect. It's a 2% discount, so the credit is times 0.98 to get that amount paid of $5,500. So we divide by 0.98. So the credit amount is going to be $5,612.24. So we take the invoiced amount, $13,707.46, and we are going to subtract $56,12.24 to get a balance due of $8,095.22 due by February 2nd. 3rd? It is 3rd, thank you. February 3rd. What do you think? Okay, there is a new quiz that is due tomorrow, Thursday, at 11:59 p.m. This is still on the statistic stuff, the empirical rule and Z-scores and stuff. And there is new homework that is due for next Wednesday. Remember, corrections on test 1, if you have not already done them, they need to be done soon. Remember, by the time we take test 2, I've got to have the corrections on test 1 or I won't take them. Okay, you guys have a great week. We'll see you next Wednesday.